Hello and welcome back to All Things Money. I'm your host, David Blain. We thank you for joining us today. If you'd like to get in touch with us on the show here, we've got a lot of ways for you to do so. Of course, our phone number, you can give us a call if you have any comments, questions, topics you'd like to see on the show is 252-633-0107. You can also email me directly at the show. The email for the show is allthingsmoney@dlblain.com. And you can go to our website, www.dlblain.com. There's a big Contact Us button in the right-hand corner. Hit that, send us a note, tell us what you're thinking, comments or questions you may have. You can also, that's where the archive copies of the show are. If you missed the first segment today, head on over there to catch up. But we're just now going to get into the meat of things. We talked a little bit about underperformance and why passive investing is appropriate for most people. Whether they're professional mutual funds or individual investors or newsletters, the overwhelming amount of data shows that it's almost impossible over long periods of time to outperform an unmanaged index. Now this waxes and wanes. Some periods of time active management will do better. Other times passive management will do better. There's a lot of talk right now in the bond market about the past decade, how active bond managers have done much better than the passively allocated aggregate bond index. And if you break down the data, when looking at returns, you have to look at, okay, where is that source of return coming? And so this fund comes out and says, well, our benchmark, what we're trying to track is the U.S. Barclays Aggregate Bond Index. And that index today currently has, I think, about 70% U.S. Treasuries. And so you have this mutual fund over here, and he says, well, we're going to be smarter than that, and we're going to invest 70% in corporate bonds. And so, yes, they have outperformed their benchmark, but was the benchmark really appropriate when they're not really investing in that type of security? So there are a lot of those games that go along when looking at outperformance, underperformance, and you have to do what's called a style analysis or a component analysis, and you can break that return down and you can see, okay, well, how much of the return was due to their exposure to corporate bonds, how much was it due to actual stock picking and things like that, and then you can make a determination as to whether they're adding value or not. And what we find a lot of times is that, let's say that manager was outperforming the aggregate index. Well, just by buying a lower cost passive corporate bond fund or index, ETF or something like that, you could have done better than that manager. So there's a lot of science that goes behind determining where the outperformance came from and whether it was due to luck, skill, or simply exposure to an asset class and a different weighting than was in the benchmark. Anyway, so when you're looking at your investments, what we want to talk about is a few things to help investors become better investors. And number one is don't focus on the price of things so much, but focus on the value. So for example, the stock market is an easy one to pick on because its prices are sort of all over the place. But the markets, individual companies have an intrinsic value, and markets as a whole have an intrinsic value. And by intrinsic value, what I mean is it's the value that that investment has, it's the cash flows that that investment can throw off. As opposed to, you've heard of sentimental value. Some people have little trinkets and things, maybe a photograph. Let's say you have a photograph of your grandmother or something. That has no intrinsic value. And by that I mean unless that person was someone famous or something like that, no one would really want to pay you a lot for that photograph. But it has a lot of sentimental value to it. The same thing in the marketplace. An automobile or a house has intrinsic value. It provides transportation, it provides shelter, things like that. It has a value. And investing is the same. A stock has a value, and it's generally, determined by the cash flows that investment will return over to you over time, discounted by an appropriate interest rate. And so whether it's a stock or a bond or or anything, you can compute an intrinsic value. And what the market is trading at, so you could have a stock that's worth $100, but the market is, you can buy and sell it for $200 or maybe $50, but that stock has somewhat of an intrinsic value to it. And in the majority of the time, the market kind of fairly prices the value. You have millions of people buying and selling that stock. And so in aggregate, markets do a fairly good job of valuing those stocks to their intrinsic value. Now, occasionally, and we'll rewind the clock a little bit back to 2008, occasionally the market gets it significantly wrong. So for example, the best companies in the market lost 40-50% of their value during the crisis. Some companies lost 75% of their value during the crisis. But even really good companies, Wells Fargo Bank was trading as low as $8, and I'm not promoting Wells Fargo. In fact, I don't really advocate people buy individual stocks. But Wells Fargo was trading at $8 a share, and it was one of the strongest banks in the country. In fact, it would have had to have a complete collapse of the financial system for Wells Fargo to fail. It never reported a full year loss during the whole financial crisis, a very solid bank, but yet it was trading as low as $8 a share. We saw a ton of companies trading at discounts. The market as a whole, when looking at intrinsic value, look at things like inflation rates, long-term growth rates, profit margins, things like that, and to come up with a value, you look at dividend payout rates. I realize some companies don't pay dividends, but it's one way of looking at it. And you can come up with a reasonable estimate of the value of something. Now, it's not a precise estimate. This is not physics or engineering where you can, this is the price of Google. This is what it's worth. It's worth, $100 a share, no more, no less. It's not. You kind of get a range, and occasionally the markets will get way outside of those ranges. 2000 was a good example. 2008 was a good example. So we encourage you to try to focus on the value, the intrinsic value, and not so much on the price that the market is quoting from time to time. Well, that brings us to our second break. When we come back, we'll talk a little bit about some common investor mistakes and how you can avoid them to do better in your portfolio. So for All Things Money, I'm your host, David Blain, and we'll be right back after a few short messages.